wealthiest people on the planet have been paying zero taxes for years, and this is the one hack you can steal and start doing the same. So when ultra wealthy people start making a lot of money from their W-2 income or their business, typically what they'll start doing is buying real estate and take the bonus depreciation from that asset to reduce their total taxable income. So they'll invest in short-term rental real estate, which is an active form of income that allows them to also offset the depreciation with that purchase against their other form of active income, which is their W-2 or their 1099 or their business that they run. So these ultra wealthy folks might buy something like a hotel, which is an active income business. It's ran as a short-term rental because number one, it's an average duration of stay of 7 days or less. So they'll use what's called the short-term rental loophole, which allows you to take depreciation on assets that are ran as short-term rental or active income businesses. This means that you do an average duration of stay of 7 days or less. So with a hotel or a boutique motel, this would qualify somebody to take massive bonus depreciation against their total taxable income. So here's the best part. You can actually do the same thing, but instead of buying these mega hotels or boutique motels, you can do this with Airbnbs or vacation rentals or short-term rentals. Short-term rentals allow you to typically write off around 28 to 40% of the total purchase price, including things like paying a general contractor, a landscaping team, a designer, your co-host team, all the other expenses that you incur after you close on the home. These can all be offset against your taxable income so long as you do it the right way. So you need to meet 3 specific criteria. Number 1, the property needs to be purchased and placed into service this calendar year. Number 2, you actually need to run it as a short-term rental, which means the average duration of stay needs to be 7 days or less. And the third criteria means you need to minimum participate in this business minimum 100 hours and no less than any other one individual who also supports this business. So the good news is you participating minimum 100 hours in the business is no problem. Typically, most investors who also have spouses will go for a 3, 4, sometimes a 5-day weekend-long visit to the property. They'll easily knock out 20 to 26 hours per day because the reason is both of their hours can contribute to that total number together. And after the home gets launched, even though your co-hosting team is doing most of the heavy-duty lifting with the property management, the guest communication, all the back and forth with the cleaning teams, managing them, and just taking care of the property, you can still log anywhere from 30 to 60 minutes per day, typically checking in and overseeing all the operations, even though you're not doing the grunt work or the legwork of actually communicating with guests. You'll typically be in the Airbnb app, looking at the messages, quality controlling, quality assuring that everything is going smoothly without doing the heavy duty lifting yourself. And this is how you can start slashing your tax bills like crazy. It's quite easy. You should buy an existing short-term rental that's already had a track record of either making money, breaking even, or losing a little bit of money every single year. And then specifically add in revenue driving amenities. So things like a landscaping team who will add in a putting green, a fire pit, stone patio walkway, and even beach volleyball courts if you have the space in the backyard. You'll also typically work with a general contractor and an interior designer to add in things like accent walls in the bedrooms and the living room. You'll do asymmetric wall patterns on some of these walls. You'll add in floating shelves where you can add in other cool, unique little trinkets to make the home feel like a premium luxury group travel experience, which is Airbnb's true product market fit. And then once you get the property live, either towards the end of this year or the beginning of the following year before you file your returns, you'll order what's called a cost segregation study. Now, this is a third-party study done by another company who's actually going to go in, assess the value of everything inside the home above the ground, and anything that has a 20-year lifespan or less, you can accelerate the full estimated value of that item or that appliance or that roof, etc., into year 1. So for example, a lot of people will buy homes in the $950,000 to maybe $1 million purchase price range. The cost seg study will indicate somewhere between maybe $220,000 to $310,000 of bonus depreciation that can be accelerated into year 1 to offset your total taxable income. In addition, if you pay another consulting team to help you find that deal, or if you pay a landscaping team $15,000 to add in value to the backyard, maybe a designer and all your furnishing budget was around $25,000, you can offset all of that against your total taxable income as well. And this is the name of the game. This is what allows high-income earners to accelerate their retirement timeline. So instead of retiring 10, 15, 25 years from now, you can probably accelerate your spouse's retirement timeline in the next 5 years. If instead of wiring $120,000 to $250,000 a year to the IRS, you could instead be funding your real estate portfolio and shielding as much of your taxable income as possible and build wealth and some semi-passive, semi-automated income while also accelerating your retirement timeline because you're saving a massive amount on taxes every single year with the short-term rental loophole.